All righty. Welcome, everyone. Welcome, everybody, to tonight's Sunday macro wrap up for Sunday, March 30th here. How's everyone doing? Hopefully, you had a fantastic Sunday wherever you are. We're going to be getting into a lot of what has to do with the labor market this week, since we get typically first week of the month is always a labor market week. So we're going to be getting into some of that data as well as my expectations, as well as my team's expectations. And then also as well, just like the title of this video says, volatility seems to be back, and, it hasn't really gone away, but it looks like it's having a second round here. So we're going to be getting into all that, the macro data, as well as my thoughts going forward, all that and more here on tonight's stream. Now, for those who are joining on YouTube, TikTok, as well as Instagram, the way that these Sunday macro wrap-ups work is typically for the first 30 minutes, we stream it. We go over some of the macro data. And then the last 30 minutes to 45 minutes is actually offline with our Macro Optics members. That's where we discuss different ideas. People can actually answer or ask me questions. We have some decent discussions going back and forth. We can even get as off topic as people want. It's a really good time. And so that happens on the last half. And so if you want to join the discussion after for the remainder of the Sunday macro wrap up, just go to the link in the description below. Or if you're on Instagram or TikTok, just go to the link in my bio and you can start your 7-day free trial of our macro investing community. And yeah, it's a great time in there. So all right, let's go ahead and get right into it here. So obviously, yesterday the markets had a pretty aggressive sell-off over the past couple days, and over the past last trading days of last week. And as we were noting, this bearish divergence here, where volume was decelerating on this bounce that we had. And so this bounce really started on Friday, March 14th. And it was about 12 days, right? Now, during those 12 days, we were talking about this slowing volume, which is a bearish divergence, and we were being very cautious of that. Now, you never know really at what point things will sell off, but we were noticing how different places of support and resistance levels were around that 575 SPY mark, and that's exactly where it hit resistance and sold off from. And so not every single time it works like that. It did work this time. And so I wasn't shorting the S&P 500. There's a lot of better shorts that are out there. But we use the S&P 500 as a proxy for, risk on, growth, that sort of thing. And so this unfortunately was sucking a lot of people in, but our macro process was saying otherwise, and that's where it comes in handy. Now, just because the S&P 500 is bearish, right? We continue to have the bookshelf in the back red. And for those of you that are new, the bookshelf is what my team and I, the color is what my team and I are focused on with the S&P 500. So the trend, right? So if it's red, bearish trend, green, bullish trend, if it's yellow, that means we're waiting and watching, and it's really a neutral trend. And right now it remains bearish. Throughout the entire bounce, the shelf remained red, and it still remains red. Not just the S&P 500 though. NASDAQ, Qs, right, still remains bearish trend. Tech was just getting hammered, and still Wall Street owns a lot of this big tech names as well as everybody else in their retirement funds, and so that's why people are not having a good time. But over the past 2 years, you got 20% plus back-to-back years, and people are upset that the market doesn't just go up in a straight line forever. Yeah. Newsflash for those who didn't know, it doesn't typically do that. And really, this recent sell-off, as much as people have been complaining about it, I mean, from its all-time high on February 19th, it's down a little over 9%. That's, barely a correction. I think people were getting spoiled with these, 5 to 8% corrections on this huge run up here. But a real sell-off would, bring this down like 30%, which in that case, that would bring us down to like 425. which would be right around the area which was the November all-time high or the December 2021 all-time high. So, I mean, that would be a decent one. Not saying that's going to happen, but I mean, again, that's what can happen in these crazy sell-offs. And from the looks of it, with I don't know if you guys can see this candle right here with volume just accelerating on this red day on Friday. I would not be surprised if we saw some carryover in the next couple trading days to start off the week on this redness. The proxy, and with the title of this video, looking at volatility, looking at the VIX, look at that. It shot right up, right above 20 again. So, when this type of thing happens, if this does end up shooting up higher, this is going to be a little bit of a reckoning on the S&P 500. So, not saying that this will happen, but we are clearly in a point right now where volatility is back. So I would not be surprised if volatility continues higher from here. And the two other things that my team and I likes to look at U.S. 10-year government bond yield, that had a pretty decent decline. My team and I were buying select names of bond ETFs last week, and it was great because our portfolios were up while everyone else was down. And that's the position that you want to be, especially during these bearish times here. And then the dollar formed its lower high, and that continues lower as well. And so part of the deliverable that the Macro Optics members get that I pay attention to a lot every single day as well is our correlation heat maps. And it's important to know because, again, if you understand what the dollar is doing and the trend, then you'll get a lot of other things right that are also correlated to the dollar. And so with this being a bearish trend, it's really important to know which assets are also positively correlated to the dollar since it's also in a bearish trend. And right now we continue to see S&P 500, Bitcoin, things like that. They continue to be in a positive correlation with the dollar. And so those are the things that you want to be selling when it has dead cat bounces like we had over the past 12 trading days. Artemis says Bank of America US high yield index also higher, so guessing higher risk sentiment from there as well. That was actually where I was going to go to next, Artemis, so good call out there. Looking at credit spreads, this is still widening from its very narrow lows. I don't know if you guys zoomed out on this thing, but credit spreads were near 23-year lows, and the last time this happened was in June of 2007. So this widening could get ugly if it continues. It's not yet above my team's 3.5 level, which is typically the level that we like to track, which it did get above there slightly during the yen carry trade freakout last year, but it did not. It was completely shot back down. So that right there, this move down, this rejection off of it was really what kicked off the next leg. And so, this does have a little bit of room to get closer to 3.5. So I wouldn't be shocked if that continued higher there. So those are the main things that I'm looking at. Mag 7 continues to be in bearish trend. Don't want to be anywhere near this thing right now. Let me go to a chart of the Mag 7. Yep. It looks a lot like the proxy for sentiment, which I like to use. And I don't know, I don't hear too many people using this, but this is the ratio between the consumer discretionary ETF XLY and the consumer staples ETF XLP. And the reason why I like to use this is because it's very correlated to Bitcoin typically. There are times where it's not exactly correlated, but if I put up a chart of Bitcoin and overlay it on top of this ratio, let me put this in yellow just so you guys can see it better than red. Bitcoin's in yellow. I mean, take a look at that. And it front ran it in some cases. So yeah, this ratio, I highly recommend you add that to your arsenal. But from here, let's go ahead and get into some of the macro data from last week. We saw, here are the highlights from last week. So consumer confidence hit a 3-year low since 2020. The consumer is not having a good time. Future expectations went to its lowest level, I believe, since 2012 or 2011. So that was even worse than the pandemic. Lots of negative sentiments. Philly manufacturing went to its lowest level since COVID, while prices paid increased. So demand slowing, prices increasing. When we take a look at the inventory to sales ratio for durable goods of wholesalers, those versus goods sold, those are converging, which typically is not a great environment. And so same thing with the employment growth for businesses' expectations and sales revenue. Those also went down. These are all just things that we're seeing for the first time since 2022. And it's not just on sentiment, which I'll get to in a second. We had an unexpected rise in PCE prices. It wasn't too unexpected. I mean, it remains near the previous 12-month level, which is around 2.8% year over year, right? Core PCE is the Fed's preferred inflation gauge, and that hasn't budged. So inflation is remaining sticky. This chart right here was pretty interesting. This is the expectation index for income groups, and all three of them, top tertile, middle, and bottom, all had the largest drop since 2022. So again, consumer sentiment not great across all income levels. Of course, we got the Fed Now, or the GDP Now from Atlanta Fed's nowcast, and that continued lower, even with the newly adjusted gold estimate that they also produced with it that actually went negative for the first time in a month. So yeah, growth continues to slow. The Cleveland Fed has core CPI remaining at 3%. So that, inflation's remaining sticky. That's really the narrative here. Commodity prices, the CRB commodity index, that had a bounce too. So commodity prices are having a bounce. The Fed meeting for May, still 83.3% chance of a pause. I'm just going to be going rapid fire here, by the way, because there's a lot of tabs. June, there's a 70% chance that they cut for the first time. So something's going to happen between now and the summertime. That's what the bond market is saying. I don't know what that is, but it's on track with what we're looking at with private and public liquidity. The Chicago Fed's National Financial Conditions Index continues to rise, which shows a little bit of a tightening effect, similar to what we see with credit spreads widening. Taking a look at some private data or some private liquidity metrics, M2 money supply. This continued to accelerate from the lowest level since 2023, but look what happened. Look what happened since the middle of November. It's been flat. I'll go ahead and zoom in here a little bit. In November, that came up to 3.7, and it's around 3.8. So really, over the past 4 months, the rate of M2 has been flat, which that's not what's been happening since April of 2023. M2 has been accelerating for the past 2 years. Now it's flat. Let's take a look at bank credit. Similar, actually, it's worse. Bank credit is decelerating. It's still positive, but it's less positive from November, right? See that? See where this really started to ramp up back at the beginning of 2014 or 2024? Bank reserves continue to be negative. We got that data last week. And this is something that we were talking about beforehand, and then actually hit, let's see, negative 8.5. Yeah, so that continued to decelerate for the, I don't know, what is that? 13th month in a row, 12th month in a row. So yeah, liquidity is not great. Consumer sentiment, not great. Growth is decelerating. All these negative things that you guys already know about. I'm probably depressing you by now if you own a lot of risk assets. if you're in our group and you've been seeing that we've been long things like gold for a while and, select gold assets and exposures, healthcare bonds, then it's okay. It's all right. We can learn to get better here. And look, there's a lot of negative data out there, but there are bull markets. You just have to know where to look. And so, as we're long things that remain resilient in these stagflationary environments, we'll just hang out there and be patient until we can finally see a turn in all this negative data. And by that time, we'll probably see a little bit of a trough in equity markets. And that's typically when you have really peak bearishness. That's when you start to see headlines in the New York Times saying, Armageddon is here. That's when we're going to be like, all right, time to buy. And obviously those headlines have not happened yet. You're starting to see the R word back in the mainstream media, recession. Top economists are saying that there's a 50% recession in 2025 now. Kind of reminds me of 2023. I don't think it's going to be that crazy yet. We still need to see the effects of these tariffs in action. But taking a little bit of a mainstream media pulse, you are starting to see those R word headlines. All right, let's get into the labor market conditions because, looking at some of the previous Fed meetings from last month, something that Jerome Powell, the Fed chair, is saying is that, the labor market remains resilient. But let's really dig into it here because I really don't think the labor market is as resilient as the central banks are telling us they are. Pretty much anytime the Fed chair, Jerome Powell, goes on TV, he is going up there to essentially lie, right? And so, yeah, let's just go through the data here. So the Conference Board, they have some pretty good leading economic indicators. They have this one employment trends index, which I really like to look at because it takes a lot of the things that we look at and put it into one thing. This actually gets updated in the second week of the month. So the last time this was updated was March 10th, but it's worth revisiting just to see what they're saying. And back then, about a month ago, 3 weeks ago, they reported that the unemployment trends index fell to its lowest level since October of last year. Growing policy uncertainty is beginning to weigh in on business and consumer sentiment, with more substantial impacts from federal layoffs and funding disruptions expected in the months ahead. And so federal layoffs, that's going to increase the unemployment rate. That's supposed to be staggered a little bit from the payout that they got. We'll see how that really rolls out, but it's causing a lot of people to, a lot of private business to not want to hire. And so you're seeing a hiring freeze right now. So if we take a look at this chart, let me zoom in on it real quick. So the blue chart is what we're looking at, and that really has been in a downtrend for quite some time. So, we're seeing data like that. Small businesses show that job creation was weak in February. So small businesses, it's not just the larger firms that are struggling a little bit. Full-time work did have a bounce in November and December, peaked in January and came down a little bit. So that could be looked at as good news, but you have to always look at employment versus temporary help. And temporary help remains negative, but it has accelerated. And so which one has been accelerating faster? The ratio between temporary help versus all employees continues to, go down. And usually when you have a sharp decline like this, that usually means that you're in the middle of a recession. So some have been using this as saying, hitting the panic button over the past couple of years, which in and of itself isn't saying that. It's just saying that, labor market remains weaker than people think. The employment level for part-time workers has been accelerating. And usually, as you see during these shaded recession regions, when you have the large spikes in part-time work for economic reasons, that's when you should perk your ears up. And if we zoom into what's happening right now, we had a pretty decent 2-month acceleration here to 4,937. which is the highest since, let's see, since May of 2021. So if this starts to really shoot up, that's when you need to have a little bit of concern there. It's starting to do that. When we take a look at the Atlanta Fed's U.S. labor demand versus supply, demand is still technically exceeding supply, but it's really right at the hair of going to where supply exceeds demand, which is not a great environment for jobs. Typically, you want to see a wide redness, right? And so that's what we're seeing right now. So this is thinning. It's getting tighter. But when you take a look at the spider chart for labor market distributions, you can see that the worst metric is private hiring. So that's even worse from 2024 until now, right? So let me get rid of that one. The green is 2024, and the orange here is 2025. And so, private hiring rates have just completely dropped off. So you're seeing a hiring freeze. That doesn't mean that we're having like full blown an employment meltdown just yet, but it does mean that typically this happens right before it. So really got to pay attention to this week's numbers. Part-time employment, like we said, had a pretty large acceleration. U6 unemployment, which in my view is the better unemployment rate to look at rather than U3, which is the headline employment rate. So the reason why we use U6 is because it adjusts by adding marginally attached workers and workers forced to work part-time for economic reasons to the officially unemployed index. So that increased to 8% from 7.5% in January. And so this was a fairly large acceleration. U6 unemployment at 8% is the highest since, since October of 2021. And the last time it accelerated from 7% to 8% was from February to March of 2020, which was the pandemic. So things are getting interesting out there, to say the least. Let's see. Where do you take? Okay, so yeah, multiple job holders that have a primary job full-time and a secondary job part-time. Look at this from January to February. That had its largest acceleration ever. Not only because, it's expensive out there, but yeah, I mean, people are realizing this this economy is kind of screwed up a little bit. And typically when you have these large accelerations, you have large drop-offs. So really need to pay attention to the multiple job holders metric there. Then we go over to the construction world, the construction sector, because really construction is a large leading indicator of the economy. And as you guys can see here, construction since 2024, the employment level has completely dropped off. That has gone down to 7,978, which let's see, which is around like the May 2021, June 2021 level. But look at this drop off in construction jobs. This is huge. That's not normal. Job openings for construction has also gone down. We already looked at that. And then total construction spending. So this is a leading indicator of construction employment. That continues to decelerate as well. And I don't hear too many people talking about the construction sector. There are some people that talk about it, but really the new construction is not having a good time. The number of unemployed persons has been rising since the beginning of 2024 and remains elevated. And yeah, so that's what really covers it for what we had recently, last month's data. The month it was reported in March, but it was for the data in February. And so this week coming up here is the labor market data for the month of March. It gets reported in April. And so really the spikes that we need to look at is the U6 unemployment rate, which comes out on Friday. And then also as well, we're going to be paying attention to construction this week. So those are the two big ones. And then we also get ISM manufacturing PMIs. So purchasing managers index. And the ISM manufacturing, that did have a slight deceleration, but it remained pretty elevated. My team and I are expecting this to continue to come down. When we break up the two metrics that we like to look at within this ISM manufacturing report, one is new orders, which had a very large deceleration from January to February. And then prices paid had a pretty large acceleration. So again, just like we were talking about a little bit earlier, new orders demand is falling while prices are going up. And so as these manufacturers are about to see with the consumer really pulling back right now, is that they're going to try to at first pass off a lot of these rising prices to consumers, and the consumers are not going to be buying them. And so ultimately this is going to cause them to lower their prices. And that's where you can potentially get into a deflationary type of scenario, which you don't want to be anywhere close to stocks at that point if that happens. So everything that we're talking about right now is the beginning symptoms of something that could really develop into like a full-blown crazy sell-off. And so it's kind of like, if you're starting to get flu symptoms and you're like, uh-oh, you got the sniffles, that doesn't sound good. Is your spit color green? Is it brown? That's what we're looking at here. I don't mean to be vulgar, by the way. Sorry about that. Services as well. So, manufacturing, we do want to look at that as a leading indicator, but really the more coincident indicator is in the services world. As you guys have heard me say before, but I'll say it again, services make up nearly 3/4 of consumption in the United States. The United States is more of a services-based economy. And so you want to make sure that you're paying attention to what's going on in the services sector a little bit more so than you would manufacturing. Part of the reason why is because during 2022, during 2023 and 2024, you had the ISM manufacturing numbers continue to be contractionary, but services remain pretty resilient. And because services were actually accelerating, that's what makes up the majority of consumption in this in the United States market. And so that was really no cause for concern. But now that we're seeing services start to decelerate a little bit, that's when you want to be a little bit cautious here, right? So ISM services, new orders has been decelerating since September of 2024. And then prices continuing to remain elevated as well. All right, so hopefully I didn't depress anyone at all. I'm just here to show you the data. I don't have any type of say. I really feel for the people who are on the negative end of all these different effects. And all we can do is pray for those people. And if you're someone who's looking for a job, I really hope and pray that you find something soon. It's a very tight market out there, and you just got to stay persistent there. And it's not going to be like this forever. And it does pose opportunities for different types of investments, which we'll get to here in a second. But there are bull markets that are out there, and we want to make sure that we have exposure to those. And so that's what I'm looking at for this week coming up. If we take a look at the actual release schedule, tomorrow we get the Chicago PMI. On Tuesday, we get that ISM manufacturing PMI that we just talked about. I'm on forexfactory.com. Highly recommend you guys keep this if you're not already using it. It shows a lot of the different releases for the economy. Not just the United States. You can look at other countries as well. Job openings. Let's see. ADP non-farm comes out on Wednesday. And then we have ISM services on Thursday. I guess Powell speaks on Friday at 11:25. What is that all about? Economic outlook of the Society for Advancing Business Editing. Okay. Probably not going to watch that. But then you have the unemployment rate on Friday. So, yep, week one of every single month is always labor market as well as ISM. And that's what we will be looking for. It could be potentially volatile, especially if we get more stagflationary data that we've been getting. That's really what's going to continue this rise in volatility that we're seeing right now. And so, what I can do here is we can go over a couple more things that I'm looking at, and then we will go ahead and go offline for just the Macro Optics members. All right, so let's take a look at a couple things here, mainly with gold. This has been one of my team's top asset allocations. Our macro model went bullish on this thing back on Friday, January 10th. And so since then, it's up nearly 15%. So our model is typically looking at, around 3 months or so as far as a trend. And so for those people who are options traders, that's how they can utilize our model there. I personally just spot buy, unless I wanted to take in some extra risk on something that looks extra juicy. But gold has obviously been one of the big winners, and not very many people were talking about it like they are talking about it now all the way back then. But that's why we like to pay attention to our model there. And emerging markets has been the talk of the town as well. And the rotation from U.S. equities into international equities has been the large move here, because all those people who own assets, they're like, hey, we need to shift here. And so that's part of the reason why it hasn't been a full-blown capitulation, because let's say you own something, instead of selling it when it's having a decline, why don't I just take some capital and hedge myself into something else that's performing better and just wait for this little blip in the markets to pass by? That's really what's happening on Wall Street right now, right? So even though they're holding the bag on a lot of these Mag 7 stocks that are going down, they are essentially rotating into some of these foreign equity markets that are accelerating in order to just hedge themselves. Once you start to see the Mag 7 stocks just completely falling out, that's when you can, officially name it a capitulation. But what Wall Street is hoping is right now is that we start to get better data, and then they can, take their hedge off with these international equity markets and put it back into the Mag 7. That's what they really want. Which, I mean, if that does happen, fine. If not, fine as well. It really does not matter when you have a macro process here. And so, taking a look at the Euro Stocks 50 index, it has been having a little bit of a slowdown in momentum here, but it still remains in a bullish trend. The ETF that my team and I like to use is EZU for the Eurozone ETF, and that remains in a bullish trend and is near the low end of the range here. There are some other international equity ETFs that we'll talk about here momentarily offline for the Macro Optics members. But lastly, what we'll do is we'll take a look at Bitcoin. Bitcoin remains in a bearish trend, similar to the S&P 500. When it was having this bounce here, volume just completely died off, right? So that was a bearish trend. And so as it came up to 88K, that was similar place right here to previous resistance, right? See that wick right there on January 13th? So, yeah. we'll see what happens from here. But we remain bearish on Bitcoin. And so that's all I have for you guys here. Now, again, for those of you joining the stream here, if you guys would like to join the actual discussion, you can go to the link in my bio. For those who are on YouTube, you can go to the description below and start your 7-day free trial. That way you can join the discussion here. But all right, we're going to go ahead and continue this offline. For those who are on the call here, the MacroOptics members that are on the call, stick around for just one moment. But we're going to say bye to TikTok. We're going to say bye to Instagram as well as YouTube. So thanks, everyone. We'll catch you next time.